What's up everyone, it's Scotty with MoneyVest, and in this video we are going to be talking about the comments from Jeremy Siegel that he mentioned a couple days ago, and then a very troublesome report from BlackRock talking about a full-on ultra rare employment recession that could be on the horizon for the US economy. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining our MoneyVest community. We'll love to have you on board, and there is a 16% annual discount also available till the end of this month, so you can take advantage of it for the next 10 days. And of course, get access to all the alerts, all the members only private videos, intrinsic value spreadsheets, our trading view charts. There's a lot of benefits included with the link down below. I'm going to share my thoughts on what I believe to be the truth as well with respect to what Jeremy Siegel is saying, and of course what BlackRock is also talking about. So this right here is the report. So Wharton professor Jeremy Siegel says the US won't spiral into a new bout of inflation even as the economy stays hot. Now, one thing that I do want to point out about Jeremy Siegel is that he was obviously very vocal, and still is, with respect to deflation. Okay, he expects there is going to be a deflation in the economy as time goes on. Now, last year, very specifically, I remember he mentioned that wages are not driving inflation because wages are lower than the actual inflation rate. So wages can't drive inflation because they are growing at a lower rate compared to what we are seeing with inflation. Since then, that has now flipped. Wages are now growing at a faster rate compared to inflation. But what's not changed is Jeremy Siegel's stance on deflation despite wages growing at a faster rate compared to inflation. That is something to keep in mind because as we're going into it, I want to give you some context. So what he says is that the US won't see a resurgence in inflation. In an interview with CNBC, he said, and I quote, "I see the productivity as being a basic deflationary force that will keep inflation in check." And he mentioned that he's not worried about inflation rebounding despite the signs that the US economy has stayed resilient amid aggressive Fed tightening over the past year. GDP is expected to grow 5.8% over the third quarter, according to an estimate from Atlanta Fed. Job growth and wage growth remain strong, with the U.S. adding about 187,000 jobs, and hourly earnings are up 4.4% on a year-over-year basis, even though CPI headline inflation is at 3.2%. That's exactly what I mean when I mention wages are up more than actual inflation. While the latest CPI index showed a tick up to 3.2% in July, the rate has obviously sharply fallen from 9.1% peak in June 22, and inflation won't accelerate as improving productivity justifies higher wages and drives more economic output. And I see productivity as being a basic deflationary force that will keep inflation in check, is what he mentioned. So the basic assumption here is that productivity is going to be higher. The US is going to be manufacturing, it's going to be producing, it's going to increase output, the GDP is going to grow to a point where there's going to be a lot more supply, right? And when there's a lot more supply, there's not enough demand. What happens? Prices go down, prices continue to go down, or prices stay down. And that's exactly what he's talking about when he mentions that more productivity is going to lead to inflation being in check because there is going to be more supply because of higher productivity and GDP growth. Now, the problem with that is interest rates are high, right? So it's not really a booming economy. When interest rates are high, there's definitely a problem for both individuals and businesses to borrow. And what we know about economic boom is that you don't really spend a lot or you don't really invest a lot when interest rates are high. When interest rates are high, what happens is you see a significant slowdown in both spending and investing. And right now we are seeing a slowdown in hiring as well. And that's exactly what BlackRock is talking about in their other report when they mention the US economy is in for a roller coaster inflation and could be headed for an ultra rare full employment recession as well. When it comes to the jobs market, the economy is in for roller coaster inflation that could hurt corporate profits. And they pointed to conflicting inflation pressures in the US with prices falling, though wages are rising. And that's exactly my point. Markets are in a new regime of volatility that could bring on a full employment recession, and the economy could be in for chaos as the US risks roller coaster inflation and an unusual full employment recession as well. Now, though inflation has eased significantly from its 41-year high from last summer back in June 22 when it was at over 9%, there are conflicting pressures in the economy that could potentially make prices more volatile in the future, and that's because the consumers are shifting their spending from goods to services, which is driving goods deflation, because again, we're shifting a little bit of our spending, but at the same time, the labor market remains tight, which is driving wage inflation as workers push for higher pay. The result, a roller coaster trajectory over the next quarters before inflation likely settles near 3%, well above the Fed's 2% target as well. And finally, this roller coaster could potentially spell bad news for stocks because high inflation can weather corporate profits by increasing costs for firms. Meanwhile, falling inflation can weigh on good prices, which is another headwind for profits, right? So if obviously if goods prices continue to go down, if there's deflation in goods, companies make less profit, margins get compressed, and they mentioned that we expect a squeeze on corporate margins if inflation stays high, and an even larger squeeze if it falls. So good economic news like falling inflation is not necessarily good news for the market as well. So we are in a very, very interesting situation because CPI did tick higher from 3 to 3.2%. Energy prices did tick higher. Food prices are in disinflation, but they are once again slowing down in the rate of that decrease. And shelter prices are also leveling off, but they're not in straight up deflation, or the growth rate's also substantially not going down, right? So it's still pretty elevated, normalized, because if we know that most of the housing market continues to be very strong, prices are stable because most home buyers are locked at 2.5%, sub 3% interest rates from 2 years ago. So there is no urgency to basically put houses on the market or basically sell despite the substantial increase in prices, because people are able to service that debt because rates are so low, or rates were so low when they were locked in for their homes. So there's a lot of different variables at play here. In my personal opinion, I am going to have to agree with Ray Dalio and a little bit of that stagflation scenario, which could continue to play out as inflation takes a little bit of longer time to get down to the Fed's target, right, of 2%, because core still above 4%, headline still above 3%. So it's going to take a little bit longer, in my opinion, as I've already mentioned, that it's a lot easier for inflation to go from 9 to 4, but then 4 to 2. Right? It's a lot easier for inflation to go from 9 to 4 than it is to go from 4 to 2. That's just plain and simple. The Federal Reserve will obviously be talking about that during their Jackson Hole Economic Symposium monetary policy meeting. Jerome Powell, I have no doubt, will be talking about that their job is not done, their mission is not accomplished yet. And of course, the market will, in my opinion, have to reprice at least one more potential hike left in 2023, and maybe not as many cuts in 2024. Markets kind of aligned with the Fed in that sense that we're expecting 4 cuts, both the market and the Fed. But I'm not even sure the Fed knows or believes that 4 cuts is going to be appropriate. Maybe it's going to be less, because inflation, in my opinion, is going to take a little bit longer to come down to the Fed's target of 2% than what previously anticipated. So that's where we are. And where does that leave us for stocks? I think if there is going to be a massive repricing in terms of interest rate expectations, only then is when I expect the markets to come down. I did a fair value calculation on S&P 500 earlier today, so make sure that you do check that out if you can. It's a very, very detailed video. So 4,000 is my S&P fair value target. If it ends up lower, then I'll be looking to deploy some of the cash that I've been hoarding. Again, I've been sitting on a lot of dry powder, so we'll be looking to reallocate that money back into the equity market. But of course, if it continues to rally like this, the momentum continues to spark prices back higher, I will be sitting on the sidelines. I'm invested to some degree, but we'll be looking at selling calls, taking some profits off the table, or simply swing trading in the meantime to take advantage of that market volatility. But for now, looking for deals, looking for stocks to come down to my fair values, letting the price come to us. And that's the right idea, in my opinion, being patient and being consistent with your strategy. So I hope you guys enjoyed this video, found it helpful. Let me know your thoughts down in the comment section below. What do you think about the economy right now? Is a recession on the horizon? Is it not? Are we already in one? What do you expect with inflation? Is it going to be higher, lower, near the Fed's target? Are we going to be seeing deflation? What do you think? Let me know in the comment section down below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.